So how's everybody? Good. Good to hear. So starting today, we're back to a lecture on Tuesday, work on your projects on Thursday format for the next couple of weeks. So today, we're going to talk about financials and collecting money. Next week we'll talk about the implementation plan, and in week 11, or the first week of the second week in November rather, we'll talk about the executive summary and your sales plan. So today's topic is financials. So, how many people in here have collected money using PayPal before? Okay, several of you. Good. For those of you who haven't, it's remarkably easy to collect money using PayPal. Takes about 10 minutes to set up, and you're in business collecting credit card payments. You can collect up to a couple $1,000s without any kind of credit approval process whatsoever. It's just a great tool in general for collecting money as a small business or as a new startup. If you have a decent credit rating, you can also do larger per transaction sums using PayPal, or you can use sort of more robust credit card vendors like TSYS, Merchant Warehouse, and Advanced Payment Solutions. Everybody functions basically the same way when it comes to online payments. Your credit card vendor takes a percentage of your sales as their service fee for collecting credit card payments for you. PayPal is the most expensive way to collect money. You're going to have a better rate if you use one of the other credit card vendors, but that requires an established good credit rating. So kind of 6 of one, half dozen of the other, depending on how your credit rating is. I put together a little chart here outlining some of the basics of the different payment collection options. PayPal, like I said, it's free to install. There's more advanced packages that go for $5 to $30 a month, and they basically charge 2.9% of whatever your sales are, 3.9% for international transactions. And that basically, like I said before, allows you to collect one-time credit card payments up to $1,000 or so. Excuse me. Without needing any kind of credit approval. Intuit Payment Network is also similar to PayPal, and has similar functionality to PayPal in terms of how it works, and it integrates particularly well with Quicken and QuickBooks. The credit card vendors, TSYS and Advanced Payment Solutions, their rates tend to vary. Merchant Warehouse is pretty solid at 2.19%. Some of the relative merits of each of them, TSYS has a robust suite of payment processing options, including trade credit for customers, for example. Lots of extensive reporting features on the software. It requires a long-term contract, though. Merchant Warehouse has better options when it comes to point-of-sale payment processing. And then advanced payment solutions may offer a better balance between online payment processing and more traditional banking services such as check processing. So advanced payment solutions is a little bit more of a traditional banking services solution as opposed to TSYS and merchant warehouse. But all of those are good ways of collecting money. Square is also a good way of collecting money. They all work very well for new startups. When you're putting together the financials for your businesses, the basic equation is really simple. Profit equals revenues minus costs. And in general, that means whatever customers are reasonably willing to pay for your product or service minus all the expenses you could possibly think of. One of the biggest challenges of putting together your financials is properly estimating the costs. There's a whole lot of costs that are involved in any new startup, and most financial plans for entrepreneurial ventures underestimate the costs. Or are missing a lot of important costs in their calculations. So a critical problem that many startups have, and this was the case for both of my companies, Avenue 2 and Market Driver, is that revenues are too low and expenses are too high. It's a pretty simple equation, but it doesn't work out well for the company when revenues are too low and expenses are too high. So as general words of wisdom for you guys, whatever you think your revenues are going to be, they're probably going to be a fraction of that to start out with. And whatever you think your expenses would be, they're probably going to be a multiple of that. So whatever you think your revenues are going to be, divide it by 2, 3, 4, whatever, and that's probably going to be your initial revenues. Whatever you think your expenses are going to be, multiply that by 2, 3, 4, and that's probably what they're going to be. The business will consume almost if not all of its own revenues. So it's not going to pay you a salary to start out with. That's another key thing to bear in mind about starting a new business, is that initially it's not going to pay you a salary. It's going to pay for it. It's not even going to pay for itself initially, but it's certainly not going to generate enough revenue to pay you a salary. So you need to figure out how you're going to pay your bills other than revenues from the venture. And then finally, it will consume almost every penny you can beg, borrow, or steal. So make sure you think ahead about your capital acquisition plan. We'll get to the capital acquisition plan a couple slides later. But actually, we won't get to it a couple slides later. We'll get to it a couple lectures later. I take that back. But really plan carefully for what your expenses are going to be, and have a really good idea of how much money you need for the venture when you go out to acquire capital. It's much better to overestimate what your costs are going to be and be happily surprised when you collected too much money, rather than not collecting enough money and not being able to cover all the expenses of the organization. So some basic tips on your revenue and cost estimates. Some greater detail for revenue and cost estimates. What are customers reasonably willing to pay? To determine that, look at your customer vignettes. That's why I've had you talking to customers and putting together customer vignettes to see what the price point is that they're willing to pay. I've also got something in here that I didn't talk much about in this class, product service vignettes. That's part of your advertising plan and it's a particular product or service that you're focusing on to advertise to people. You want to estimate your revenues based on what your customer acquisition goals are and what the price charged is in the product service vignette. So whatever price customers tell you they're willing to pay in their customer vignette, that's the price that you should plan on in your financial estimates. And the financial estimates are going to be based on how many customers you can realistically acquire in a certain time frame. So questions to ask as you're putting things together. First of all, do you have enough product service vignettes? I didn't require you to put together product or service vignettes for this class, but basically what that is saying is, do you have enough products or services that you're offering for sale? If it's not, in some cases you may be focused on just one product or service or one price point, one package, and you may ignore other ways to bundle your products and services for sale. So make sure that you think of enough different products or services that you come up with a decent amount of revenues. The next question is, are your customer acquisition goals high enough? It's a double-edged sword, your customer acquisition goals, because on the one hand, you want to be really conservative about your estimates of how many customers you can acquire. On the other hand, not acquiring enough customers means really low revenues and not a very exciting financial projection sheet for investors. So think realistically about how many customers you can acquire, but also realize that you may have to push yourself to acquire more than what initially seems reasonable in order for the venture to really be financially viable. And then ask yourself, can you really acquire the number of customers that you need given your competition? So 3 questions to ask yourself when you're putting together revenue and cost estimates. Cost estimates or revenue estimates. Cost estimates, it's the basic question is, what are all the possible expenses you may have to spend money on? I've listed several here that should be listed in your financials somewhere. This is not an exhaustive list, but every venture in here will have some form of variable costs. So you've got raw materials, including transportation sometimes to get the raw materials to where they need to be, and labor, including taxes and benefits, etc. There's other variable costs as well, but the ones that should absolutely be in your financial projections are raw materials and labor, at least. Another question to ask yourself about variable costs is what quantity you have to buy things in. A lot of times, I think a good example is labor. If I think about the rickshaw project, for example, you may want to hire somebody that only runs the rickshaw 2 hours of the day. That may be what you actually need for the rickshaw, but you may not be able to find anybody that's willing to work 2 hours a day. They may need to work 8 hours a day in order to make enough money to pay their bills. So sometimes you can't just buy 2 hours of somebody's time. You have to buy a full time equivalent employee. Same thing for other types of raw materials. Sometimes you can't just buy one case of beer from the distributors, you have to buy 10 or 20. So important to research and figure out how much, what quantity you have to buy things in. For your marketing costs, things that should definitely be in your cost estimates are brand development, advertising, networking, and that networking should include meals and expenses and transportation as well. Depending on the exact nature of your venture, a lot of new ventures require a lot of networking and schmoozing to find partners, to find customers, to get things off the ground. And you'll find that the money that you end up paying to take people out for lunch or for dinner, for coffee, for drinks, and the driving costs to get there and get back, the gasoline, the depreciation on your car, add up a lot faster than you think. So definitely when you're estimating your marketing costs, don't forget about your meals and expenses and transportation. Those are an important part of the marketing costs for most small businesses. Overhead costs, I've listed a lot here. Office space, utilities, telecom and internet, information systems, including both hardware and software, R&D and product development, training and development, IT services, accounting services, legal services. All of those at one time or another are going to come up as costs for your new venture. You need to make sure to have estimates for each one of those in your financials that you put together for this class. And that's not an exhaustive list either. There's other potential overhead costs that I didn't list that may be relevant for one or the other venture as well. And then finally, executive compensation. What do you and your partners reasonably expect to earn above and beyond the equity value you're building? So it's not realistic in the first year or two of operations to have a salary that comes out of the business for yourself. But when you're making projections for a 5-year financial projection, you got to figure in there that around year 3, you're going to start paying yourself a salary. And you need to think about what level that salary is going to be once it finally comes in year 3 or so of your operations. I've listed a couple of tools here that are particularly useful for financial planning. There's an Excel template on Blackboard that I'm going to show you guys in a second that is kind of my go-to tool to use for your financials. There's also some great tools that are available from SCORE, which is an acronym that stands for the Service Corps of Retired Executives. It's basically retired executives that do consulting for small businesses. They've got a lot of great financial planning tools on their website as well. Our SBDC has a nice webinar Wednesday series that has some thought leadership on revenue and cost planning. And then Google is also useful at times for figuring out brainstorming costs. So jumping out of here for a second and going to the tool that I mentioned, this spreadsheet here that's called Pro Forma Financials Sucre. It's not. I don't think it's showing up on your version of Blackboard right now. I need to fix where it appears in Blackboard, but on my version it's right here, and you'll notice that it basically has 4 tabs: statement of cash flows, income statement, balance sheet, and statement of shareholder equity. Those are the four main financial statements that any company prepares. The statement of cash flows is basically a list of all of the money that comes in and all of the money that goes out, with dates and descriptions attached to it. That's where everything starts for your financial projections. So this is an example here that some of my students put together a couple of years ago for a bakery venture that they were working on in Cincinnati. So you'll see here they were planning on doing 12 birthday parties, and doing 16 sports extravaganzas, which basically means they were going to provide catering for a party for school sports after the end of the season. So these do not have dates attached to them, but they do list all of the revenues that the company expects to come in over the course of a year. So there's two different ways to estimate revenues and costs. One is to start with all the costs and then estimate revenues based on the costs. The other way is to think about how many customers you can realistically acquire, calculate the revenues first, and then calculate your costs based on what the revenues are. So this example starts with the realistic revenues and then builds costs off of that. So realistic revenues were 3 weddings, 12 birthday parties, and 16 sports extravaganzas. Pricing for each of those is listed here. So $250, $450, $650 for the weddings, $35 for the birthdays, and $35 for the sports extravaganzas. The total of $2,300 in revenues. It's not very much. It's not very much at all, but it's what was realistic for getting started. Based on that, you can then calculate approximately what your expenses should be based on estimates. Here it says from Hoover's. This is actually going to be from First Research Industry Profiles for you guys. First Research Industry Profiles has, for pretty much every industry you can imagine, they have a summary of that industry that includes, among other things, detailed financial ratios for that industry. And as long as you know what your revenue number is, then all of the ratios for what variable costs usually are in a small business in the bakery industry, for example, what variable costs usually are as a percentage of revenues, what marketing is as a percentage of revenues, what overhead costs are as a percentage of revenues, and what executive compensation is as a percentage of revenues. They're all available on that report. So you'll start by calculating how many revenues are realistic, and then you'll calculate your costs based on these percentages that you get from the First Research Industry Profiles report. You'll notice here 11.4% is the variable costs item for bakeries. So that means if revenues are $2,300, about $265 is how much the company should be paying for the ingredients and so forth, the raw materials that go into making the various foods that the bakery bakes. 4.5% is the marketing budget. So according to this, if they're going to have 2,300 in revenues, they shouldn't be spending more than about $100 on marketing. So it's sobering to think about the fact that they've only got $100 to work with for the marketing budget if their revenue estimate is 2,300. Overhead costs are by far and away the biggest part of a bakery's expenses. That's 78.1%. And you'll notice this 1,819 is 78.1% of 2,300. And then finally, executive compensation is 3.6%, which means if they're making $2,300 in revenues, then the salary, as it were, of the people that own the bakery is $80. Not very much. So this is the beginning of your cash flow estimates. You start by doing the statement of cash flows in the financial statements, and then you move on to the income statement, this next tab here, which basically summarizes it adds together the total of each type of revenue that you have and summarizes that in a subtotal for revenues here. So So this was actually, these estimates here were monthly estimates before. So according to those monthly estimates, if you take those numbers, multiply them by 12, that gives you revenues for weddings for the year, and the same thing for birthdays and sports extravaganzas. So that means total of about 27,000 in revenues for the first year. Variable costs, marketing costs, overhead costs, executive compensation are based on those percentages that I mentioned. Or, alternately, you can take the number that's listed here in the statement of cash flows and multiply it by 12. So that gives you the total expenses, which makes the operating revenue about $600. After that, you need to think about interest expense. So basically the interest that you're paying on any money that you borrowed for the company. Taxes, so you got to pay taxes on whatever your profit was. And then finally, depreciation and amortization. I've left that blank for now, but any assets that you own lose value over time. So if you bought a laptop computer, for example, for the business, that computer is going to lose value each year that you own it. So you need to account for that too. Long story short, these cells here in this spreadsheet automatically sum up the more detailed numbers from the statement of cash flows, and it gives you a summary of all the money going in and all the money coming out of the business over the course of 1 year. And then the columns here for year 2, 3, 4, 5 are estimating growth by a certain percentage estimate. So it's assuming a 10% increase in revenues each year and a 5% increase in costs each year. And then you'll notice here some other comments for the interest expense and taxes. Your balance sheet is summarized by taking information from the income statement. So in the income statement, you've got your net revenue, whatever that is here. Cash on hand for the business is going to be, that's where whatever your profit was from the prior year in your income statement, it goes into the cash account here for the balance sheet. You've also got accounts receivable, short-term assets, and long-term assets. Accounts receivable is basically things that you've already sent people a bill for, but they haven't paid you for yet. In this particular spreadsheet, that's estimated as 1 month's worth of revenues. So cash is going to be income statement C25. So this profit figure here added to 5,000, which is the amount that we started with when we started the business. Accounts receivable, is going to be income statement C25 times 1/12, gives us about $20 worth of receivables. And then short-term assets and long-term assets. You'll notice here I've made some assumptions that you had investors that came in and gave you money for the business, and you took some of that money and you spent it on short-term assets. So basically, the ingredients for the bakery goods. Long-term assets, you spend another $2,500 from the investor's money and put that in long-term assets. So that's things like your computer, desks, chairs, oven, kitchen equipment, things like that. And then 5,000 of your initial money went to cash. I've assumed in this example here that you have $2,500 in credit card debt in your liabilities. So the balance sheet is basically a summary of everything that you have and everything that you owe at a certain point in time. So this will be at the end of year 1, end of year 2, end of year 3, end of year 4, end of year 5. And I've automated a lot of these cells for you guys. So if you fill out the first page of this correctly, most of the rest of the spreadsheet will populate itself. So that's your balance sheet. And then finally, the last statement in here is the statement of shareholder equity, which basically is a record of who owns what in the company. In this example, there were 3 investors and the founders of the company. The 3 investors each got 25% of the company, and the founders kept the other 25%. This is the total value of the company times 25% for each of the 4 stockholder groups. So that's a template that I'm going to put at your disposal for calculating financials for your ventures in here. I need to actually, the easiest thing is just to open this up. And permit users to view it. So now when you guys go to the course documents section of Blackboard, you'll see lecture materials, professional development, and then you'll see another item that says lecture materials financials, and that has the spreadsheet tool in it that I just went over. It also has a number of other documents that are helpful in calculating your financials. So if I go back to the spreadsheet now, or back to the presentation, the last thing that I wanted to talk about in your financials is ratio analysis and why it's important and how to do it. So the point here at the bottom of the screen is the key one as far as entrepreneurship is concerned. Ratio analysis is like a reality check to see how you compare to other businesses like yours in the industry. So if your ratios are close to what the industry average ratios are, you know that you're sort of on the right track with your business. If your ratios are very different than the industry average, then that's usually an indication that there's something wrong about your planning of the business. So there's four main types of financial ratios: profitability measures, liquidity measures, leverage measures, and activity measures. Profitability measures are basically important for understanding a company's business model. So some business models have a very large gross margin, very small net margin. Other companies have other business models have very large variable expenses and not too much overhead. So profitability measures are a good way of understanding the firm's business model. Liquidity measures are important for understanding a company's ability to pay its bills. So there's how much money you have and how much money you owe. And if you have less than you owe, then it's dangerous for your ability to pay your bills. So there's a ratio to calculate which basically divides how much you owe by how much you have, and that number is sometimes a lot higher than 1, sometimes very close to 1. It depends on the industry. So your reality check for your ability to pay your bills is different depending on what the industry is. Leverage measures are important for understanding a company's actual hard value. It's possible for a company to be very highly debt leveraged. It's possible for an entrepreneurial venture to have very high valuation for the future if people think that it's going to be a really big success. However, the valuation of what you think is going to be the case in the future versus what you actually are worth today are two very different things, and leverage measures are good at showing you what you're actually worth today. And then finally, activity measures are important for understanding when and how cash and products flow in and out of the company. So the main ratios that it's important to know how to calculate for profitability ratios are the gross and operating profit margins. The formulas for those are right here: sales minus cost of goods sold divided by sales for gross margin, and sales minus operating expenses divided by sales for operating profit margin. Your main liquidity ratio is the current ratio, which is basically your current assets divided by your current liabilities. The main leverage ratio is called the long-term debt to equity ratio. That is basically your long-term debt divided by your total stockholders' equity. And the main activity ratio is called average collection period, and that's basically your accounts receivable divided by the quantity, total sales over 365. And it basically shows you how long it takes you to collect your payments from your customers. I've listed a couple of links here that have all kinds of additional ratios that are interesting and useful. They go beyond the main scope of what I think is necessary for this class. The main thing that I think is necessary for this class is that you know how to calculate these four ratios here. Like I said, First Research Industry Profiles is the main source of reports on average financial ratios for a certain industry. So if you click on this link for First Research Industry Profiles, and type in bakery product manufacturing. So these are the ratios for the bakery industry. So if you scroll all the way down to the bottom of this document, it says financial information, about 2/3 of the way down. Company benchmark information, this is where all the ratios are that you need. So net sales is always 100%. Gross margin is basically your variable costs minus it's your net sales minus your variable costs. So this is saying that your variable costs should be 100% minus 27% is about 73%, 72.7, I think. So 72.7% should be, once you've calculated your revenues in the spreadsheet, you're going to multiply that by 72.7% to get the variable cost number that you expect for the company. Same thing for advertising and sales, 0.4%. Officer compensation, 1.7. This is your executive compensation. Other operating expenses are your overhead costs, basically. All of that goes together to help you fill out this spreadsheet here. So the percentages are a little bit different in the document that I just pulled up compared to the Hoover's numbers here, because the Hoover's numbers here were for catering services as opposed to bakery products manufacturing. They're both slightly different industries. So that's where your ratios are going to be. That's where your cost ratios are going to be, and then your ratio analysis ratios. 27.3% is going to be your gross margin. Quick ratio is listed right here. Long-term debt to equity is basically you divide the long-term liabilities number by the net worth number, and the activity number, your average collection period, is going to be for the industry, it's 18 over 100 over 365. That's if we calculate that. .274. So on average, in the bakery services business, it takes about 65 days. So if you calculate this number, 18 divided by 100 over 365, it's 65.69. So it takes about 65 days to collect your money from customers in this industry. Those are the main ratios and where to find them for the industry. That is also the end of the PowerPoint presentation. So basically what I want you to do for your financial estimate for your ventures is fill out this spreadsheet here. So you're going to take out the numbers that are in the spreadsheet. The numbers in the spreadsheet right now are examples. So you're going to take all the numbers out from the statement of cash flows and replace them with your revenue estimates and your cost estimates. Okay? Does that make sense? Okay. That is about 50 minutes worth of lecture. That's all I got for today. So does anybody have any questions about what I went over? Yes. By when do I want what? Basically by Thanksgiving. No problem. Any other questions? Okay, then I will see you guys on Thursday.